Okay.
Thank you, Doctor.
Thank you, Doctor. To you guys.
You're ready to go.
Thank you. Good afternoon to everybody, and it's nice to see a lot of great faces and great colleagues and great acquaintances. Thank you very much for participating in the ERF research and contributions. As we have said, we have 15 minutes for each presenters, and I will, since I am the discussant of each one of them, I will be making my comment after each, and I have, I think, 5 minutes. I'll try to stick to time, and then we'll go to the second and do the same thing. Please try to adhere to the terms of our conference in terms of time, because we have a limited time. And we have our first paper, How Economic, Political, and Institutional Factors Influence the Choice of Exchange Rate Regimes. New evidence from selected countries of the MENA region. And the paper is by Najia Morawi and Thuraya Haj Omar, I think is then Islam Kubasha. Please excuse my mispronouncing your name. I live in the United States and everybody mispronounce my name. And we have a Christopher Ralt. These are the presenter will be, who's going to be the presenter, you guys?
Soraya will be presenting.
Yes, Soraya will be presenting.
Yes, okay. Hello. Okay, I will share my presentation. Is it clear now?
Yes, it is. You may want to put it on full screen, but yes, it is. It's very clear.
Okay, so today I'm very glad to present my paper co-authored with Najia, Islam, and Christophe. And I would like to take this opportunity at the first to thank you, Dr. Ibrahim Al-Badawi and Dr. Shireen and all the team of scientific committee to accept our paper, and also all the organizer team of this webinar of 27th ERF conference. So let's begin to introduce my paper. Our paper entitled How Economic, Political, and Institutional Factors Influence the Choice of Exchange Rate Regime. So the question of choice of exchange regime is not new, but it's renewed with the new financial and economic architecture, and also with the macroeconomic imbalance, but also the strong political and social instability and the poor institutional quality, especially in the MENA region and emerging country, and in particular in MENA region. Until the end of the Second World War, the prevailing exchange regime was the fixed regime, but since the collapse of Bretton Woods system in 1971 and the movement of floating currency, also following the exchange rate crisis in 1990s, which affected emerging countries, and as I said, the new financial and policy architecture characterized the main emerging economies, and especially the MENA region. The question of the choice of exchange rate continue to attract the attention of economists and political decision makers. So the question which arises here: what are the economic and financial as well as political and institutional determinants affect the choice of exchange rate regime in MENA region? here we follow the following plan. This work, we start with to introduce the introduction, then we underline the main literature review. And third part, we focus on the interest on the empirical investigation, then and the main results, and finally we conclude. Let's begin by the determinant of the exchange rate regime from the theoretical background, which classified the determinant on three big classes: economic and financial determinants, political determinants, and institutional determinants. So let's begin by a reminder: the economic and financial determinants, which explain the choice of exchange rate, and we begin with the OCA, the optimum currency area, which is the main answer theory, and this theory is based on three main work of Mendel, Mendel, Fleming, which here. Who suggests the country with immobile capital, immobile factors of production, capital, and labor are more likely to adopt a flexible exchange rate regime. Mackinnon, also 1963, emphasized the degree of economic openness, suggesting that the more open the economy, the more appropriate the choice of fixed exchange regime. And Kenning, 1969, focuses on the level of economic diversification. Also, we found the Mendel triangle of incompatibility, or the Trinity of Mendel, 1963, which involved that it is impossible for a country to achieve simultaneously the following three objectives: floating exchange rate regime, perfect mobility, and also capital monetary autonomy. Then we found also in this the same context the natural of shocks. Indeed, in the case of, for example, nominal shocks, it's more preferable that to opt a fixed exchange regime. Contrary, when the shocks affected the economy are real, the choice of the flexible exchange regime is more feasible. And we know also the theory of fear of floating of Calvo and Renard, which mean that a country announces that is floating, but it actually adopts a fixed exchange regime. Let's focus now on the political determinant, and this is our contribution to introduce new factors that the previous studies determined it, but not on MENA region. So here, we refer to some author as Edwards 1996 and Frieden, that they found that political instabilities induces the government deficit, which favors the adoption of a flexible exchange regime to fight against this deficit. While Elisina and Weiner and Honing in 2009 found that political instability decreased the economic activity, which favors the adoption of a fixed exchange regime in order to ensure the credibility in inflation control. Other determinant, also political determinant or policy determinant, is the election. So here, Frieden, we refer to the study of Frieden, which suggests that during the election period, the choice of a fixed exchange rate regime is more feasible in order to decrease inflation and increase economic growth. Whereas Bernard and Leblanc, 2009, suggest that during the election, During the election period, the choice of flexible exchange regime is more preferable in order to maintain the independence of monetary policy to ensure economic growth in order to win the election. And also there is other important determinant as a political determinant is the partisan theory. The partisan theory suggested that for Alessina also suggested that the left part are more likely to use an expansionary monetary policy, resulting in an increase in the real exchange rate, and therefore they more likely to adopt a flexible regime, exchange regime. And finally, the fifth determinant is the government strength. Also has an effect on the choice of exchange rate. And many authors, such as Aiken Green, for example, 1992, and Edwards, 1996, have found that strong governments have the capacity to cope with a currency crisis by acting on reserve stocks, and therefore have the capacity to follow a fixed regime. This is for the political determinant. Now for institutional determinants, the theoretical background spared from some studies as Frieden and Hajfaj 2018 studies suggested that in the case of poor institutional quality, a fixed exchange rate regime is more feasible in order to strengthen credibility, control inflation, and ensure the valuation of the national currency. However, Steinberg 2013 suggested that the institutional quality is poor. When the institutional quality is poor, it generates political upheavals which decrease the growth. Hence, a flexible exchange regime is more preferable to use an expansionary monetary policy. Also, another variable of institutional determinants is the type of political regime. The type of political regime, whether is autocratic or democratic, has an effect on the choice of exchange regime. Indeed, Leblanc, 1999, in his article, proves that democratic governments support an expansionary monetary policy. Therefore, these governments are more likely to implement a flexible exchange rate regime in order to ensure domestic stabilization and therefore economic growth. And the other determinant is the central bank independence. Here we found also two opinions from the previous studies. Steinberg and Walter suggested that the independence variable, the independence of central bank often makes more difficult to stabilize the exchange rate. So the use of flexible exchange regime is more appropriate. While Bernard Brose and Clark 2002 suggested that the central bank independence provides credibility by controlling inflation in the case of price stability, where a fixed exchange rate regime is more feasible in order to ensure credibility.
Sorry to interrupt you, please.
Yes.
We have about 3-4 minutes more.
Okay, so I will present directly our empirical and the main results that we found in our studies. So here our study covers 8 countries in MENA region during the period as shown 1984-2006. We used 3 types of variables: economic, political, and institutional, classified as the table show. The model here following the course classification of Renard and Rogoff 2008 extended to 2016 for 8 MENA countries during this period. And the model is written as follows. So our estimation showed that empirical model regression have the following results. So the first model, we integrate economic variable. We use that all the variables are significant except of financial development. For the second equation, we use we integrate the economic variable with the political and institutional variables, and we found that the majority of variables are significant, exception of political risk and financial development, and also central bank independence. And the third model, only the political risk variable is integrated. And here we think that is not significant, this data, this variable. So here for the model 4, we keep all the economic, political, institutional variable, and we eliminate the political risk while replacing in this with this main component in the sensitive analysis step in order to find out the main result. Here we diversify the variables through the different components of political and institutional determinant. From the variable added, for example, for the first model, monetary independence is not significant. For the second model, foreign direct investment, the result is significant and negative, and this is mean that high degree of foreign direct investment increase the probability to opt for a fixed regime. Let's focus on the main determinant. For example, for the question 5, government stability and also political risk. For the 6th, yes. Okay. For the 6th model, also political risk through internal conflict, the result is positive and significant. And this is mean for government stability that a situation of political stability, high government stability, has a low probability of maintaining fixed regime. And the same result is confirmed by the internal conflicts. Internal conflict, we think that the result is positive and significant, and which means that in a situation of political stability, for example, low level of terrorism, political violence, and disorder, the probability of having fixed exchange regime is low. Now, for institutional variables as corruption and law and order, the result is mitigate, because no conclusive, because for example, when there is a low corruption, the result is negative and significant, means that in the case of low corruption, a fixed exchange regime is more likely. But when for the law and order, if the law enforcement and order decrease the probability to adopt a fixed regime. For bureaucracy, there is no
try to conclude.
Just 1 minute, and I conclude. I should summarize the result. Democracy is a negative and significant the result, which indicate that democracy is linked to a fixed exchange regime, and this is contrary to the previous study of Leblanc 1999. Donc, all the results are summarized in this figure. Our study also reveals the neutrality of certain variables, such monetary independence, real shocks, elections, bureaucracy, social economic condition. Also, financial development is not a robust determinant, as it is not significant in several specifications. Finally, we can said that there is now exchange regime is universal or eternal, but it's imperatively to study according to the economic and financial characteristic, but also political and institutional of the country. So the choice of exchange rate regime depends on the economic, financial, but also political and institutional specificity of each country. And to continue this work, we need to extend by treating it for each economy independent on the other. And thank you for your attention.
Thank you very much, Thuraya, for your presentation. And I'm going to make my comment, and then I'll open the floor for people to, if they have any comment or concern or questions. My comments about the paper, I read the paper. I always enjoy reading papers on the Middle East and on international finance. The author my comments is the author contribution to research project or the introduction of the segmented political factors rather than to sum them up in one. They segment political factors into different factors and the factors which is they call component in the MENA region, and to determine which of these factors have an impact on the choice of the exchange rate regime. The paper stated that they have studied 8 countries. However, just a minor, probably you need to look at is you have listed 9 countries, and you see based on the version I received, you look at page 4, paragraph 2, they listed 9 countries, probably something that need to be fixed over there. Again, I did not see the last version of this. The author utilized the random effect order probit model of the likelihood of exchange rate regimes on potential economic, political, and institutional determinants of exchange rate regime for the period of 1948 to 2016. The table 1 is based on 8 countries rather than 9 countries, which we have 33 years and 8 countries, which is going to give us the total observations of 264 observations. Table 2, it would be very good if you can separate the variable based, as you did in your presentation. You separate the variable based on financial, variable, and political and institutional. Again, in the tables, they were kind of all mixed together. I would like to see the tables are a little bit more organized as you did in your presentation. That will be good for the submission if you try to submit it to a journal. Again, that will be a good one. Again, a complementary, and it makes it a lot easier because of so many factors we are studying, so many variables. It will be easier probably for the reader to try to summarize these based on what is the factor, what is its impact, the sign positive or negative, which is, we alluded to that, and what is the impact on the regime. You will see that, I believe, the Ms. Huda will be giving you some of my comments, or I can email you my comments. Well, you could say that the gross national product, GDP, the sign is negative, the regime is fixed and up or down. And you list all of them. That will be, I can look at these different factors and I will be able to determine, because going back and forth between up and down, fixed and other type of variables, sometimes it is not that easy to do that. And you can do that for each one of these categories. And then it, for instance, you say government and expenditure, the sign is positive, and fixed and down, and then it leads to a crowding out. Does it lead to crowding out? Now you're talking about the crowding out when we talk about expanding government expenditures. Crowding out, and that the crowding out, what's the impact of that on monetary policy and fiscal policy of that need to be a little bit more expanded on some of the explanation or justification for your conclusion on these variables. Since the degree, and in terms of statistics now, since the degree of correlation between the predictor variables, gross national product, inflation, and other variables affect the frequency with which authentic predictor variables found their way into the final model, it will be possible for the author to improve the profit model if they can run a factor loading analysis. So many factors, so many variables, and they have many co-founding, or at least they lead to many probably same information or purported by the same factor, and we cannot really tell for that. A factor loading model or backward or forward probably regression can eliminate some of these factors that they are not, or at least have a co-founding effect on others. So we can, would probably improve the model rather than to have all of these variables. You can mention that, that you have done that, and reduce the number of factors to come up with which one of these factors really are loading factors. Sometimes the model specification can be improved by doing that, but some of the factors, yes, they are there, they have an influence, but the influence is so minute or minor that probably it is not that necessary to include it, and it can be probably found by other factors. Again, we can have a police for every person in town, but what at cost? Sometimes we have to look at it from the efficiency of the model. The author need to determine if the predictor variable stationary over time. Are these stationary over time? And if they are not stationary over time, do they change to fit different financial, political, and institutional factors? I mean, if there's some change in regime, some change in, do they stay the same? The impact stay the same? And if they are not, we need to probably segment the data and try to look before and after certain political events or certain large financial shocks like the 2008 and the pandemic of 2020. So these are, again, something that probably can improve the paper itself. It is important to mention the shortcoming of the multinomial profit model. The multinomial profit model have some shortcomings. Most of the time, it will be a very good idea to mention that in a footnote. The model is susceptible to few estimation problems, the most serious of which is that it often leads to a weak identification in application. When you apply the model, weak identification is difficult to diagnose and may lead to a plausible yet arbitrarily misleading inferences based on what we're going to come up with. I also have some places where we can talk about this. I don't want to take a lot of time. I think that is about my time. And I want to open the floor. Again, you can respond to my comments, but I would like to give the floor first to audience. If they like to have a question, probably they are the same question as I have, and then I'll give you the floor to respond. Thank you very much, and good luck with your paper.
Thank you very much, Professor Mahmoud Haddad, for these precious comments. Yeah, I will take into this all the precious remark in our paper and in the future to improve our article in order to submit it. About the justification of economic model, I don't know if you need a reply, and so given that there is an order of involving the exchange regime strategically in the data, and since the dependent variable exchange regime is of the multinomial type, we use an order probit model. Also, given the panel structure of the data set, the possible existence of inobservable country effects has to be taken into account, not to be the estimation result. Also, as discussed by Scott 1948 and ASIO 2014, estimating a fixed effect model will, with small and fixed t, transmits the inconsistency of the incidental fixed effect model with So here, other research papers, such as, for example, Elaine, show that unlike the random effect model, the non-linear framework agree relatively. So poorly with the fixed effects. This is empirical confirmed in our investigation when testing for the appropriate form of country-specific effects. In what followed, we consider a model with random effect rather than fixed effect. If I understand your comment about the economic model. For the sample, yes, we will maybe classify the sample by the specificity characteristics of the country, MENA region. So that's why we think that we will continue to provoke this debate, but in each country, and we take case by case this different determinant to explain the choice of exchange rate for each country.
Thank you very much. Dr. Ibrahim would like to make a comment and probably have questions. Dr. Ibrahim, the floor is yours, sir.
Thank you, Dr. Mahmoud. Yes, I would like to also thank Dr. Suraya and her colleagues for this very interesting paper, interesting topic. But I think there are some important determinants, potential determinants that they may like to consider. For example, the smaller the country and the more open the country to international trade, just like the GCC countries, they tend to favor fixed exchange rate regimes. Also, countries that have a large industrial or agricultural lobby, they also like to choose flexible exchange rate regimes. For example, countries like Chile or Norway, where there are very strong agricultural lobbies, they like to use fixed exchange rate regimes. So I think these factors are important to take into account because it has political economy implications. When you have a large agricultural sectors or industrial sectors, then you expect a very strong agricultural lobby that would like to have flexible exchange rate regimes so that they can actually compete internationally through a more competitive exchange rate. When you have a small country that is resource endowed like the GCC countries and open to international trade and investment, they would like to maintain a fixed exchange rate regime because the capital account is much more important than the current account for these types of country. Thank you.
Thank you, Dr. Ibrahim.
Dr. Mahmoud.
Yes, ma'am.
Can I just bring your attention? Dr. Mustafa Deseli would like to have the floor.
Yes, go ahead, Dr. Mustafa.
Thank you, Dr. Mahmoud. Suraya, I also really liked your presentation. I actually have one recommendation, not a query, in the sense that, so when countries, but this would be then more applicable for a larger data set. So when there is a fixed exchange rate, then the question is to which country are these currencies, to which country currency are these currencies pegged? And one of the elements that might be interesting to look at is looking at the former colonial powers. This might be an interesting research question, but this is my personal opinion, of course. Thank you.
Yeah, thank you very much, Dr. Mustafa. I agree with you. I was one of the comments also I may have the last minute. That is, some countries are forced to certain type of, rather than given the choice by any of, I mean, I don't know if that can be classified as political, but they are, as to your point, they are forced to follow certain currency and fixed or pick their currency to, it's not by choice, it's by force rather than any of the, I don't know if that is type of the political. Another questions, comments, concerns? We thank you. We thank you, Thuraya, and we good luck with your paper. Hopefully, you will be able to send it and publish that. I like.
Thank you.
Yes.
Thank you very much, Professor Mahmoud. Thank you for your comments, and thank you also for Dr. Ibrahim Badawi for these precious remarks, and for Dr. Mustafa also. Thank you. I will, inshallah, take into account this all this remark and this commitment, and I hope to summarize all this by email. It will be more pertinent for me if you have time, Professor Mahmoud. So
we'll do that.
Indeed. Yes, indeed.
We'll
will be collating all the information from Dr. Mahmoud Haddad and will be sharing it with the
Thank you. Thank you very much.
Thank you very much.
Inshallah. Thank you. The next paper is the banking market power, its determinant in the MENA region, by Muhammad Shafi'i, I believe, Shafi, and Paulo Moracos. And I think that is going to be presented by Dr. Shafi'i. Did I say correct, Dr. Shafi'i?
Yes, I hear you. Thank you.
Yes, sir. Go ahead. The floor is yours. Please try to adhere to 15 minutes if you don't mind, please.
Yeah, thank you. Thank you very much. This is a joint work with my colleague Paolo Coccariz from the University of Salerno. The paper, as the name mentioned, the title mentioned it, is we try to evaluate the market power and the determinants in the MENA country. The aim of the study here is to explore the determinant of market power in MENA by focusing on the loan market. That means we are evaluating market power on the loan markets. We have several novelties compared to other paper dealing with market power in the region. We provide what we call product specifics learner index in the loan market. That means compared to other, most of the study in MENA region evaluating the market power, all those studies usually consider an aggregate learner index for all the bank's activity. I will come back to this point later. Second point, second novelty is that we focus on the link between switching costs and the learner among other characteristics. By switching costs, we mean the cost that the customer face with the process of switching from one bank to another. And the intuition is when banks have some market power, they lock in their customers by increasing costs for customer if they want to switch to another competitor. So the switching cost is one of the main determinants of market power in this study. This third novelty is even if in some recent literature we have mainly two papers linked to switching cost and market power, the papers don't consider the endogeneity issues between switching cost and market power, which is an important issue when you run regression on some determinant, while those determinants are maybe endogenous. The last point is within MENA region, we take into account countries' heterogeneity by considering in our analysis what's happened for the GCC versus non-GCC country. The link here, I provide some literature on bank competition in MENA. You can find some papers which evaluate the degree of competition in MENA, and most of the literature show that the degree of competition in MENA in the banking sector is much lower compared to other world regions. Some papers investigated the link between market power and stability in MENA region and show that market power reinforce stability of the banking sector. There is some papers which consider the link between competition and bank efficiency, or more recently, some literature which consider a link between competition and economic growth. And more competitive markets, banking markets, provide better, higher growth. The most close papers to ours is the recent paper by MENA 2020, who explored the relationship between learner and switching costs and bank stability in 17 countries, including MENA. But the main limit of this study is that market power is estimated by an aggregated learner index, which should prove to be criticized in recent literature. And only 2 studies consider the link between switching cost and aggregate learner, but endogeneity issues has been neglected. The methodology followed in our paper is we estimate the cost, a multi-product cost function. That means we have a cost function with 2 outputs with a vector of input prices. Following the recent paper by Schaefer and Spijtjik, we estimate a multi-product cost function instead of one product function by aggregating all the outputs together. We test for the separability assumption, and according to those authors, Schaefer and his co-author, if the cost function is not separable, the best way to estimate error is to estimate the specific learner on each output. We consider 2 versions of the learner index, the so-called unrestricted learner. That means you estimate the learner without imposing any restriction on the sign of the learner index, and the restricted learner, which impose that restriction. This is the model, the cost function. Marginal cost, you take the derivative of the cost function with respect to the output, to each output. Here we have 2 outputs, loans and other earner products. We focus on the learner on loans. That means the learner on loans is just the difference between the price of loans minus marginal cost of loans over the price. While the restricted learner consider, you take just the marginal cost equation, you add another term, it call it the markup, and it imposes the restriction that the markup is one-sided. That means you run stochastic frontier model to estimate the learner, while here with this learner, equation 3, there is no restriction on the sign of the learner. For this reason, you can observe for some cases the negative learner. That means the price are under marginal cost. The switching cost is evaluated according to the SHI model. It's an old paper 2002, but it is the only methodology available to estimate the switching cost without running some surveying for the customer for each banking system. The switching cost equation is based on the output price and the market share of each bank. The data, we have 30 MENA countries, 200 banks. We use bank scope plus world development indicators with macro control variable, market capitalization, GDP growth, inflation, and some control, size, diversification, and so on. So let me start with the learner index. With the learner index, we provide estimates of the learner by country. This is the average value. The average value is 42%. On the right side, you have the restricted learner, but the correlation coefficient between the two learners are very close. That means overall, the average learner is relatively high compared to other countries, but within MENA region, some countries are much more competitive compared to others. For example, Lebanon has a very high level of the learner index on loans and Kuwait compared to Tunisia, for example, which has the lowest learner index. The second result is overall, if you take the percentage growth rate of the learner of the period, the studied period 2000-2018, the growth rate of the learner is negative -1%, -0.2% for the restricted learner. That means overall, within the MENA region, the competition between banks is improving. But exception is Egypt, where the growth rate of the learner is improving 3% per year on average. That means within this country, competition between banks is not improved. We also estimate the switching cost. Remind that it's the cost, this is an estimation of the cost if a bank customer switch to another competing banks. The average switching cost on loans is 10%. That means if we take the example of one customer who have a loan with his banks for $1,000 US dollar, if he want to switch to another bank, he must pay 10% of 1,000. That means he must pay $100, which is a very high cost, switching cost.
Mahmoud, sorry to interrupt you, but 4 more minutes, please.
Yeah, thank you. I have 5 minutes more. Okay.
Go ahead. But
okay, thank you. So the switching cost is high compared to the estimates of switching costs, for example, provided for European countries. In a study by Laurent Weil, the switching cost is 5%. That means $50 instead of $100 in MENA if a customer want to switch. The calculated switching cost on loans, if we evaluate the switching cost on all bank activity, the cost is also high. But overall, the switching cost, the growth rate is negative. That means the switching cost is decreasing over the 18 studied years in MENA region. Let's move to the determinant of the learner. Before we run our regression, we investigate the endogeneity issues between learners and switching costs, between learner and cost efficiency, and between learner and diversification. And those variables, by applying the Durbin-Wu-Haussmann test, those variables are endogenous. So in the determinant of the learner, we, in the second step, we estimate the model by, we take an autoregressive dynamic model, panel data. We have the endogenous variables is the learner, lagged variable of the learner. You have the first package here is the bank characteristics and market characteristics. You have in the second, this is the baseline model. The second model, the same model by adding macro variable, and the third model, we add macro variable and add some bank tip, that means foreign and Islamic banks. What is interesting, remind that cost efficiency, diversifications, and switching costs are considered as endogenous within the estimation method used, which is the GMM system. What is interesting is whatever is the model, the specification of the model, the switching cost has a positive and highly significant impact on learner. This is in line with our main assumption, but some characteristic with respect to cost efficiency, more efficient banks are able to increase their market power and so on. We have also estimated, I have 2 minutes, we have also estimated the learner by region. What is interesting is most qualitatively, most of the determinants of the bank characteristics are significant, but the size, the magnitude of the switching cost is differs within according to region. So the empirical finding summary, when customers find it costly to switch providers of banking service, bank are able to charge higher prices relative to their costs. This is the positive impact of switching cost. Banks that better manage their cost structure benefit also from higher prices. This is the positive impact of cost efficiency. Size has a negative impact. The smaller bank enjoy a higher degree of market power, and more concentrated banking markets allow banks to exploit more market power. You have here, when you estimate the model for GCC, non-GCC, the yellow, that means the yellow color, that means you have the same impact, the same similarity, and the differences for the second color, there is some differences with macro and also with respect to bank tip. We also check the robustness of our results by estimating within a system. We estimate a system of 2 equations, one equation for learner and one equation for switching cost, by using 3-stage least square method, and also by using the restricted learner in one step. That means the determinant of the learner are estimated in one step within the restricted learner, and most of our results are qualitatively robust. I move to the conclusion because I guess I have just 1 minute, I hope. Conclusion and policy issues. MENA banks enjoy a substantial degree of market power on the loans market. The average market markup of the price of loans on marginal cost is very high, about 43%. MENA banks switching cost is very high, 10% of the loans amount, which is a very, very high amount, which means that once a MENA customer is captured by his banks, the probability that he will move to another bank is very low. So these banks can fix higher loan rates when their customers are locked into their current banking relationship. Also, banks' market power appears to be higher when banks are more efficient, focus on the traditional intermediation activity, have a smaller size, or operate in countries where stock markets are less developed. Reducing policy issues, reducing switching costs imposed by banks on their customer is crucial to improve competition by, for example, reducing the bureaucratic barriers to the switching from one bank to another, developing bank account portability. This is the case in MENA Bank for telecom operators, facilitating competition and encouraging of new entries, so any substantial barrier should be eliminated, more incentive to increase cost efficiency, develop the capital market, and encourage new bank entry instead of bank entry through bank acquisitions. Thank you.
Thank you, Mahmoud. Very interesting and enlightening papers. I enjoy reading it. I will say my comments and you can comment on them after that. The author investigated the degree and the determinants of a bank market power in 13 MENA countries for the years 2000 to 2018, with a special focus on customer switching cost and bank cost efficiency on banks' market power. What is the impact of these on banks' market power? They showed that bank market power is more robust using the decomposed, again, they took the learner index and decomposed the learner index into its components. And they showed that instead of using a total asset as the measure of market power, the author compared the restricted and unrestricted learner index on loan to determine market power. That is mainly the paper. The author showed that the higher a bank competition, the lower the profit, the weaker the bank market power. They showed also that determination of the various learner index depends on the cost of productive asset rather than total asset, the asset that produce the revenue. However, the model in terms talking about the productive and cost efficiency, the model have ignored off-balance sheet commitments, financing, and off-balance sheet cost. Hedging and hedging cost, there's a certain cost associated with hedging, derivative swaps, etc., transactions, and there are other transactions that have cost and have, some of them have benefit because hedging can be positive or have a positive or negative impact. The author concludes that the cost function of MENA banks is better represented by a multi-product function rather than an aggregate function of output, and that the degree of competition of the market is better assessed through specific rather than general learner index rather than the index itself as it's been used before. However, higher switching costs, they lead to more market power, higher switching costs. Now, when we talk about the switching cost, I would like first to ask whether you have 200 banks over 13 years. Are these customers, all of them individual customer, family, residential, or are they business customers? There will be switching costs, size of the loan, size of the different type of transaction, usually different for business transaction versus individual transaction. That will be determining if it is or it is not. I don't know if you separate them or not. It didn't say anything in the paper. What percentage of customer switch? Are they a minor number of customers switch, or they everybody switch? And if they switch, why would they switch? What is the purpose of switching? Is it because of late fees? Is it because of overdraft fees, type of service? We said also only cost, but cost sometimes there are a hidden, sometimes cost that probably the bank does not service. the customer himself, and it's not really switching because of the cost itself, because the bank himself do not service the customer. What are the improvement in determining bank market power and competitiveness between using restricted and unrestricted? What is the difference between them, and why we have that restricted and unrestricted? What is the marginal improvement? What is the impact of the 2008 financial crisis on banks? Switching costs, non-switching costs, operation, and the market power and competitiveness, which it comes to that. In section 5, empirical evidence can be summarized in a footnote. I mean, we have so many in section 5 talking about different type of models, different type, and this to the paper itself, I think to the core issue of the paper, or the core property point of the paper, this section 5 can be summarized to make the paper is a little bit more acceptable to certain journal, because too long and sometimes it gets too confusing to read. Few observations need to be defined at their first line. At the beginning, when you start, at least the version I received, you have many observations that I have to go in the paper or I have to search for them. Readers do not like that really. So you need to, anytime you use the first time abbreviation, please try to identify what is this abbreviation stand for. Also, sometimes we can use H statistics, and you need, probably you alluded to that in your paper, that H statistic indicate that banking market structure is not constant over time. You know that some of the concentration method that they use is the H statistics, and that H statistic is indicated most of the time that the market power of the bank is not constant over time, and this will be again another probably market segmentation, or to segment your data between before 2008 and all these financial statements. I will be, because of time, I will be also sending you my notes and some of the characteristics of the H statistic and its impact on how to determine market power, and what is the margin, how the marginal cost is affecting determining the market power. Again, I enjoy reading the paper. I think that is important to know that whether the client is customer versus business, then because marginal cost is different. Sometimes dealing with banks, from my, at least working for some insurance companies, that you can negotiate cost, you can negotiate discount, you can negotiate many services behind the scene that banks can do. So the cost, the explicit cost is not really the true cost most of the time for at least business. Individuals, sometimes they have to suffer, and that is the case in many other places. I do thank you very much, and I will open the floor right now for you to respond, and for also any of the colleagues if they have a question, comments, or additives to add to what we have said. Thank you very much for your presentation.
Thank you. Can I answer to your comment, please?
Yes, sir. Yes, sir.
Yeah. So thank you.
Dr.
Thank you.
Shafii, would you like to stop sharing your screen so you can?
I'm going to answer to Dr. Mahmoud's comments. Is it possible to answer?
Yes, absolutely. You may want to stop sharing your screen so we can see you speak. It's better.
Stop sharing. Okay. Okay. So thank you, Dr. Mahmoud, for your comments. I will enjoy to receive them in order to improve the paper, even if the paper has gone now to is already submitted. I hope you get the last version of the paper, because you mentioned some typo or some abbreviations. I hope it is not the last version. It's maybe the first version of the paper.
Maybe, but usually my comment based on what I received, sir.
Yeah, okay. Because I have sent the last version to Huda on April, and I said that this was the last version of the paper. Of course, the issue of off-balance sheet. There is a literature which consider that when you estimate a cost model, multi-product cost model, off-balance sheet activities for bank is important, and ignoring off-balance sheet may introduce some bias on the estimation of the cost function itself. The problem with the off-balance sheet within MENA countries, if you take off-balance sheet activities, not all the banks have that information in bank scope data. That means if you restrict the sample to those banks which provide the off-balance sheet information, that means the estimate in the market power would be will be wrong, because you have some missing observation, missing important banks. For that reason, off-balance sheet could not be included while estimating the cost model. The second point on the customers. Let me remind that what we estimate is an average cost. For example, as I mentioned, the switching cost of 10%, that means if customer lambda want to, whatever is his bank, it's an average value within MENA region. If he want to switch to another bank, he will pay 10% of the amount of his loans. That means we don't have the possibility to estimate a specific switching cost by customer characteristics, because we need it is an interesting issue, but we need to complete the data set by conducting a survey on bank customer within MENA. But to my knowledge, I didn't see any survey or any disposable information which allow to estimate such specific costs by customers. However, if you have details on the loans, for example, you have
Dr. Mahmoud, let's conclude, please, because we for time.
Disaggregate.
For comment.
Sorry.
We need to conclude because of time, interest of time.
Okay.
From the floor has a comment.
Okay, I will move to another comment. The impact of financial crisis. It is possible to add a dummy variable as a determinant for the financial crisis. It's possible. Market power. The marginal cost. The difference between the restricted and the unrestricted learner. That is, with the restricted learner, it's a methodology to impose the non-negativity of the learner, while the traditional learner don't impose that. And for that reason, you can obtain some negative value of the learner, which are unbelievable. Thank you.
Thank you very much. I'll open the floor for anybody who might have a comment or concern or additives.
Thank you.
Anybody from the floor? I see nothing. I hear nothing, I think.
Professor Mahmoud, I have one query, but probably this is done in the paper. If you do this learner index, Professor Mohammed, have you controlled for country-specific learner indices? Because you can do for the entire MENA region, but you can also do country-specific learner indices. Like, I don't know how you have you only estimated one learner index, or have you considered for each country separately?
No, I estimated the cost function for all MENA banks by including country dummy, but it is the learner, I have the marginal cost for each bank, but the information is captured from the estimation of a cost model for all MENA region. It is possible to estimate by country a cost model by country, and then derive the learner. It is possible.
Okay, but you have tackled it with a country dummy variable. Okay.
Okay.
Yes,
Thank you. Thank you. Also, probably Dr. Mahmoud, is if you try also to differentiate between Islamic and non-Islamic bank. I did not, because again, the structure is different, the loan is different, and probably that will be another distinction. And anyway, let's go to the third paper because of time.
Yes.
Thank you very much, Dr. Mahmoud. We enjoyed the paper.
Thank you.
Our third paper is favoring the small and plenty Islamic banking for medium, small banks. And that's again for enterprises, medium loans for micro, small, and medium enterprises. The paper is by Umayya Abdussalam, Ahmed Yasan, or Aysan, and Mustafa Disley. And you have 15 minutes, sir, and I'll try to finish hopefully, and then we'll continue with that. Thank you very much for your presentation. Go ahead and start, please, Dr. Mustafa.
Thank you, Professor Mahmoud Haddad. By the way, Professor Haddad, we have a separate paper about this switching cost for Islamic and conventional banks, and that is now in a second round review, but I just wanted to say that. Okay, so before starting, I would like to extend my gratitude for all the organizers of this conference. I also would like to thank Professor Mahmoud Haddad for chairing this session. No, this paper is about Turkey, and the Turkish economy is heavily dominated by SMEs. So, which means that large enterprises make up only a small fraction of firms, and SMEs in Turkey are very important for jobs. So they are more important for jobs than the European Union average. Their contribution to employment is about 9 percentage points higher than the European Union average. However, the opposite is true for the value added. So the SMEs average contribution to the value added in Turkey is about 5 percentage points lower than the European Union average. Especially micro and small SMEs in Turkey are not doing well in terms of value added. Now, as you all are aware, SMEs are widely recognized as being the engines of economic growth, and access to formal finance is believed to be one of the main obstacles of financing these SMEs. Why is this? Because SMEs are opaque because of their, are opaque because of their nature. And another thing is that banks have limited specialization in lending towards SMEs. It is also the case that banks do generate higher administrative costs when they are lending towards SMEs. So if you take a look at this, so then it follows that suitable alternatives should be provided to close this SME financing gap. And one area that is particularly in need of further examination is the role of Islamic banks in tackling the financial exclusion. Now, it is said that Islamic banks have some kind of advantages towards conventional banks. Why is this the case? It is mainly believed that Islamic banks are more involved with relationship banking. And this would then close the funding gap of the SMEs. So the main research question of this paper is whether Islamic banks are more engaged with SME lending. Let me give you some a very brief background literature overview. So it is shown that small banks have a comparative advantage in relationship lending to small businesses. Why is that? Because small banks have fewer layers of management, which then enables them to engage more with relationship lending. In terms of bank ownership, it is on average, it is evidence that foreign banks are less likely to lend to small businesses. And one explanation for this is that foreign-owned banks are large and they are often headquartered at considerable distance from the local small businesses. Another study, another finding actually about, now again about bank ownership is referring to state-owned banks. Bertai and his co-authors, they have found that lending by state banks is less pro-cyclical than lending by private banks. So this less pro-cyclical means that those banks, state banks, are lending more when the economy is suffering. The very scant literature so far has showed that Islamic banks are more inclined to engage in small business lending than their conventional counterparts. Let us immediately look at the sample period and the data sources. The sample period is unfortunately from 2006 Q4 until 2014 Q2. Unfortunately, I said unfortunately because we don't have a more recent data in our possession. There are 4 Islamic banks in Turkey during this sample period. There are 36 conventional banks during the sample period. The Islamic balance sheet and income statements are retrieved from the website of the Participation Banks Association of Turkey, and the conventional bank data comes from the Banks Association of Turkey. And the unique SME data is retrieved from the Central Bank of the Turkish Republic. So if you look at the data, we have 3 size categories. So loans to SMEs are further classified into 3 lending categories, and this is then done according to their size. And for each size category, we have information about the volume of loans, the non-performing loans, the revenues that the banks extract from those loans, and the letters of credit. The estimation strategy is as follows. So this is our basic estimation model, but I will explain you in detail what they are representing. So the dependent variables is represented by this Y, and it represents one of the SME relationship measures for bank I to borrower type J, and T signifies the quarter. And the borrower type, as mentioned in my previous slide, this is the distinction according to the size category of towards those SMEs. So we have micro-sized, small-sized, and medium-sized enterprises. And further make a distinction in terms of lending. So the volume of loans, the lines of credit, the lending rates, and the non-performing loans for each size category. Of course, the variable of interest is the Islamic dummy variable, which equals to 1 when those banks are Islamic and 0 when they are not. In terms of bank level control variables, we consider the equity ratio, the liquidity ratio, the deposit funding ratio, the profitability ratio, bank age, and bank size. Furthermore, this T in the equation represents the time dummy variables. And to cope with this potential heterogeneity problems, instead of using lagged explanatory variables, we have opted in our reporting to use initial values of those variables. However, when we replicate all the models used in this study with lagged explanatory variables, the coefficient estimate of the variable of interest remains most of the time qualitatively the same. So the differences in lending behavior towards SMEs between Islamic and conventional banks are derived from the coefficient estimate on the Islamic dummy variable. Let us now look at the results. So as you can see, we make also a distinction between share regressions and growth regressions. Let me for now focus on the share regressions. The share regressions signify the lending to total assets. And as you can see, the coefficients are all positive. Islamic banks extend on average more SME credits than their conventional counterparts. This is not only true for the entire SME market, but this finding also holds for the different size categories. When we look at the growth regressions, with the growth regressions, those are the first differences of the volume of lendings. So as you can see, the coefficient estimate for Islamic in the growth regressions is not different from zero. What does this signify? It indicates that the difference between Islamic and conventional banks in credit allocation is persistent, at least for our sample period. It is persistent, at least for our sample period. We have done some extra robustness checks, of course. So in the results that I showed you, it was only Islamic banks versus conventional banks. We further make a distinction among those conventional banks. We have controlled whether they are state banks, foreign banks, and private banks. We have also used fixed effects regressions. By the way, until now, we only considered the actual loans, but all results also hold for loan commitments. We, however, find that Islamic banks charge more on extended loans than their conventional counterparts. So the loan rates for Islamic banks are higher. The asset quality, which is expressed with the non-performing loans, the asset quality for Islamic banks is not different from that of conventional banks. And finally, we find that Islamic banks are more engaged with counter-cyclical SME lending. As said before, this means that Islamic banks are more inclined to lend when the economy is not doing well. And this is my final slide. So this is the conclusions. So after controlling for bank characteristics, we find that Islamic banks are more engaged in lending towards the SME sector. So this also shows that Islamic banks diversify more their loan portfolio towards SME finance. Islamic banks also exhibit lower cyclicality of SME lending. The asset quality of the Islamic banks is not much different than their conventional counterparts. So actually, all in all, Islamic bank financing is actually positively correlated with growth. Why is that? Because SMEs, as said also earlier, form the backbone of economic development. Thank you all.
Thank you very much, Dr. Mustafa, for even adhering to time. That is very good. Thank you, sir. I will again make my comments and open the floor after that for you and for our colleagues to make comments or additives. The paper empirically is investigated whether Islamic banks are more apt to serve or to service the micro, small, and medium enterprise. Since micro, small, and medium enterprise play a vital important role in the non-financial business economy in Turkey, this study fits what we call, or what they call, a case study analysis. The author conclude whether the bank orientation being conventional versus Islamic has a significant role in explaining its lending concentration. They find that Islamic banks are more involved with micro, small, medium enterprise financing. The author stated that Islamic banks are more inclined to finance small and medium-sized enterprises, and that their credit extension toward micro-sized firms does not differ from privately owned domestic bank or conventional bank. Islamic bank do not, first of all, Islamic bank, I believe, do not extend interest-bearing loans, when we call it loans, to any business. It's my understanding of Islamic bank. I might be corrected, but that's what they don't give an interest-bearing loans. Islamic banks do not, the author stated that in the analysis of other aspect of lending behavior, again, lending versus entering into virtual contractual agreement is different than loan, find that Islamic bank outperform their conventional peers in terms of foreign exchange lending, the extension of letters of credit, and generate more revenue from service of these entities, small and micro, small, and medium. Are these, again, interest-bearing transaction, or are they different transactions? When we look at that, we talk about small banks. Can they take large, most of the Islamic banks, only 4 of them, and they are small relative to the conventional banks, and they have probably limited capital. Can they take large loans or large project, if you will? Or this is why they specialize in small businesses. The author stated that their results show that these micro, small, medium enterprises lending by Islamic bank tend to be on average less cyclical. I'd like to know what is the definition of cyclical. Is that in terms of time duration? The time is short term, probably, rather than turnover, higher turnover. I do not understand the term cyclical. Probably they need to be explaining that a little bit more rather than the word cyclical. Cyclical sometimes in economic, again, I can be corrected from economic mean that will be based on business cycle or based on weather or what have you. Are they shorter in duration due to transaction or contract characteristic itself? The author stated that their quarterly data set comprises 36 conventional bank and 4 Islamic bank through a quarter 2006 quarter 4 to 2014 quarter 2. It is not surprising that Islamic bank have more favorable attitude toward small businesses because of their capital structure. Table 1, it is a comparison between Turkey and European banks. And again, I don't know if we can compare small Islamic banks in Turkey versus a small Islamic bank in European countries. Conventional, again, size of businesses, etc. That has an important, due to value added, efficiency, cost, tax regulation. The economic structure of these countries sometimes different, and it impact the ability of bank to function in a way similar to other countries. The study is from a quarter 2006 quarter 4 to 2014. In table 1, it started from 2015. It says that it is started from 2015, so I don't know why it says table 1 data is from 2015. Maybe a typo. You need to look at that again based on the paper I received. If the data encompass every bank in Turkey, then we are not dealing with sample, we are dealing with population. If it is contained every single bank, conventional Islamic, therefore we're not really dealing with sample, we are dealing with a population. And therefore, we don't have to worry about historicity. And therefore that will be because we're dealing with every single data because we deal with population. Ordinary least square statistical model contains many confounding variables which cause spurious association. Too many variables. Is it possible to use factor loading analysis model before the stated ordinary least square model on page 10? to eliminate the non-contributing factors or variables. Do not have to worry about heteroscedasticity because we're dealing with population rather than sample. How about the impact of 2008 financial crisis? Possibility to split the data to before and after. I know we will not have enough data for after the pandemic, but I think that 2008, since it is contained in your data, that will be an area probably to split. Table 3, explain how bank age is determined. The data start in 2006. Is it possible that some bank exists before 2006? Therefore, their age is different than if they start before and so on and so forth. Table 4, what is the economic significance for non-performing loan? The difference and significance for non-performing form for conventional bank loan and Islamic bank loan or project. I believe Mudaraba is most of these Islamic bank. Table 4 will be easier to read and interpret if it can be segmented based on enterprise characteristics, micro, small, rather than to fit all of them back to back. The paper can be shortened by summarizing the result of table 5 to 12. You have table 5 to 12. I think they are unnecessary. You can shorten that, and you can include them or include the summary about them and tell them that they are available to viewer upon request, because again, that is something that can improve the paper. I also, in my comment, I'll be sending to you, or a helpful site I sent to you where you can look at some of these summaries and what I have done. Again, I enjoy reading the paper. The paper can be really valuable. I do thank you for your presentation and for your contribution to the ERF. I'll give you the floor, and I'll give the floor to the rest of my colleagues if they have comments. Go ahead, sir.
Thank you, Professor Haddad. So I took notes of your comments, inshallah. But what I just for clarification, the first table has nothing to do with our sample size, because the first table is about the SME situation in Turkey. It's not, there is no, those are very general statistics. This just to show that SMEs are important in Turkey. Unfortunately, we don't have a very recent data, but in terms of, for instance, capital structure, bank size, we try to control that in our regression analysis. This factor loading models might be an interesting, might be an interesting option to look at. I will definitely look at that. But what was very interesting, what you said was the following: this enterprise characteristics. As you know, we work with bank level data, Professor, and if we could match enterprise data with bank, that would be much better, to be honest. But we don't have that data. We don't have that data in our possession. And in terms of cyclicality, what we have done, Professor, is you mentioned that it's like business cycle, and we look at whether the business cycle, how the business cycle influences the lending behavior, and we show our results at least shows that Islamic banks tend to lend more during bad economic times. This was it. Thank you very much for all your comments, Professor.
Thank you very much, and again, good luck to you. And I'll open the floor for anybody who would like to say something or add.
Dr. Mahmoud, there's Dr. Shafai had his hand raised, and should he have...
Dr. Shafai, the floor is yours, sir. Dr. Shafai, can you hear us? I don't know if he can hear us or not.
Okay. He can probably hear us. Maybe his mic is on mute. Dr. Shafai. Okay. No?
Any other comment, concerns, additives, preservatives, none of the above? That's one of the multiple choice questions every time I conclude my lecture at my class. Again, I do thank you for your attendance, participation. I thank the ERF for giving us the opportunity to present and to discuss and to be part of contributing to the Middle East economic development. And that is a great venue for us to present our work.
This is most kind, and we want to thank you, Dr. Mahmoud, for an excellent job in moderation and for your very rich discussants' comments. And Hoda will be in touch soon to be sharing the discussants' comments and to be requesting the authors to take them on board and resubmit so that it can be considered for the working paper series. We'd also like to encourage the authors to consider an article for the ERF policy portal, the forum, because it really helps us extend the outreach of the work once the paper is published. And with that, I thank you all and wish you all a lovely evening.
Have a good one. Good evening, everybody. Good evening. Good day for me. I'm going to start today.
Good day for you.
Thank
you very much. Thank you very much.
Thank you. Bye-bye.
Thank you. Bye-bye.
Good evening.